In today's video, we're going to examine a question that comes up frequently among international investors, founders, and CFOs. Between Denmark and the Netherlands, which country actually offers the better tax environment for businesses? We'll walk through the key elements of each system, look at where each country is more attractive, and close with a balanced view of how to think about the decision in a strategic, rather than purely tactical way. Let's start with the headline figures. On corporate income tax, Denmark applies a flat rate of 22% on corporate profits. The Netherlands, by contrast, uses a two-tier system, a lower rate on the first band of taxable profit and a higher rate above that threshold. As of recent years, that has typically translated into an effective headline rate that is slightly higher than Denmark's for large, highly profitable entities, but potentially more favorable for smaller or mid-sized companies whose taxable income sits largely in the lower band. For a large multinational, this means Denmark's flat 22% can be very predictable, while in the Dutch system, careful planning around profit levels and group structure can materially influence the effective rate you pay. However, headline corporate tax is only one part of the story. When we look at the treatment of dividends and withholding taxes, we start to see more differentiation. Denmark generally levies withholding tax on dividends paid to foreign shareholders, although there are exemptions, especially where EU directives or double tax treaties apply. The Netherlands has long positioned itself as a holding company jurisdiction. Dutch participation exemption rules and a broad treaty network can make it easier to repatriate profits with reduced or zero withholding tax in many structures. For groups that plan to route global investments through a regional or global holding entity, the Netherlands often offers more flexibility and, in practice, smoother cash repatriation than Denmark. This is one of the reasons that a significant number of global corporations have historically chosen the Netherlands for their European or global holding structures. Now let's look at incentives for innovation and intellectual property. Both Denmark and the Netherlands are high innovation economies, but their tax tools differ in focus. The Netherlands has been particularly proactive with IP regimes and innovation incentives, including favorable treatment for income derived from qualifying intellectual property and generous R&D deductions. This can significantly lower the effective tax rate on profits tied to patents, software, and other IP, provided the structure meets substance and nexus requirements. Denmark also offers R&D incentives, including enhanced deductions for qualifying research expenditure, and the ability in some cases to receive cash refunds of tax credits for loss-making R&D-intensive companies. For early-stage tech businesses and deep tech ventures, that cash flow support can be very valuable. In practice, the choice between Denmark and the Netherlands for IP-heavy companies often comes down to the specific mix of R&D spending, the stage of the business, and whether the focus is on near-term cash support or long-term optimization of IP income. Turning to personal taxation, this is an area where Denmark is notably high tax. Danish personal income tax rates are among the highest in the world, especially at the top end, and social contributions, while structured differently than in many countries, still result in a significant overall burden on high earners. This is an important consideration for owner-managed businesses and for companies that plan to attract top global talent on net of tax compensation packages. The Netherlands, while not a low-tax country, typically offers lower marginal rates on personal income than Denmark, and has historically provided specific expatriate regimes designed to attract highly skilled migrants by granting partial tax relief on certain income elements for a defined period. For businesses that rely on internationally mobile executives, this can be a decisive factor in favor of the Dutch system. That said, any expatriate regime is subject to political and regulatory change, so it should be viewed as an advantage rather than a guarantee over the long term. We should also consider social security and labor costs. Denmark's model emphasizes high-quality public services financed through general taxation, which can simplify employer-side social charges in some respects, but sustains a high overall tax environment. The Netherlands has more explicit employer social security contributions, affecting the total cost of employment. The net effect on an employer's cost base will depend on salary levels, workforce structure, and specific social security categories. But for many international businesses, Dutch labor costs can be somewhat more moderate than in Denmark. especially when combined with the broader personal tax environment. Another critical element is VAT and indirect taxation. Both Denmark and the Netherlands operate within the EU VAT framework, with relatively high standard rates and similar compliance obligations. Denmark applies a single standard VAT rate on most goods and services, with fewer reduced rates, which can make compliance relatively straightforward, but offers less nuance in managing VAT costs. The Netherlands, with multiple rates and specific exemptions, can be more complex but also more flexible for certain industries. For many businesses trading across the EU, however, the indirect tax differences between the two countries will be secondary to corporate and personal tax considerations. From a structural and reputational standpoint, the Netherlands has long marketed itself as a gateway to Europe, benefiting from a large network of double tax treaties, established advanced ruling practices, and a generally pragmatic tax administration. While EU and OECD initiatives have pushed all jurisdictions, including the Netherlands, toward greater transparency and substance requirements, the country remains a favored hub for holding and financing structures, provided those structures have real economic presence. Denmark, by contrast, positions itself less as a tax hub and more as a stable, high-trust environment with strong governance, predictable regulation, and a highly skilled workforce. For businesses that prioritize reputational robustness and want to align with jurisdictions perceived as high tax but high integrity, Denmark can be attractive despite the higher burden. Ultimately, determining which country offers the better deal depends heavily on business profile and priorities. If the primary objective is to establish a European or global holding company with efficient profit repatriation, favorable treaty access, and robust IP and innovation tax tools, the Netherlands often has the edge. It can deliver a competitive, effective tax rate for large multinationals and offer a more balanced personal tax environment for executives. If, however, the focus is on building a long-term operating business in a highly stable, socially cohesive market with strong public infrastructure, a highly educated workforce, and R&D support that is particularly beneficial in early stages, Denmark may offer greater strategic value, even if the nominal tax rates are higher. For founder-led companies where owners are resident and fully taxable in the jurisdiction, the personal tax implications in Denmark can be material, and that should be modeled carefully before committing. For globally mobile founders who can choose where to reside and where to locate the holding entity separately, the Netherlands' combination of corporate and personal tax features may be more compelling. The key takeaway is that there is no one-size-fits-all answer. A better deal is not just about the lowest tax rate. It is about the alignment between your business model, capital structure, talent strategy, and the broader ecosystem each country provides. A robust decision process should include detailed scenario modeling of effective tax rates over a multi-year horizon, consideration of substance and governance requirements, and an honest assessment of where your leadership team and key assets will actually be located. Before making a final choice, it is essential to seek tailored professional advice that reflects your specific structure, industry, and growth plans. In summary, the Netherlands tends to win on holding company efficiency, IP-driven tax planning, and a more moderate personal tax environment, while Denmark stands out for stability, societal infrastructure, and early-stage R&D support, albeit in a higher tax context. The right answer for your business will depend on which of these factors you value most.